Good morning, everyone, and welcome to the Morning Bell. I'm Robert, and joining me as always are Lizzie and Steve. It's Thursday, February 5th, and we've got a lot to unpack today. Markets are showing some serious volatility, particularly in tech and crypto, so let's dive right in. Lizzie, we're seeing some pretty dramatic moves across the board. Bitcoin briefly dropped below $70,000, the Nasdaq just had its worst two-day drop since April, and there seems to be this contagion effect spreading from tech into crypto. What's your read on what's driving this broader risk-off sentiment?
Robert, what we're witnessing is a classic case of interconnected market stress, and it's revealing just how correlated these asset classes have become. The tech sell-off isn't happening in isolation. We've got traders piling into hedges after the software sector took a beating, and that defensive positioning is creating this feedback loop. What's particularly notable here is the comment from Treasury Secretary Bessent saying the US government won't bail out the crypto industry. That statement alone added significant pressure to an already fragile market. When you combine that with the broader tech weakness, you're seeing institutional players reassess their risk exposure across the board. The crypto market erased 15 months of bull market gains in just a matter of days, and Bitcoin ETFs are experiencing substantial outflows, about $2.9 billion in total, as BTC hit new lows for the year.
That's a significant shift in sentiment, and it seems like we're seeing this flight to safety mentality take hold. The fear gauge in crypto is definitely elevated, and we saw 800 million in liquidations when Bitcoin set that 15-month low under 73,000. What does this mean for the near-term outlook? Are we looking at a temporary correction or something more structural?
I think we need to separate the noise from the signal here. Yes, the short-term technicals look weak, and sentiment has clearly deteriorated. But let's consider what's actually changed fundamentally. The AI infrastructure build-out hasn't stopped. Enterprise adoption of blockchain technology continues, and institutional interest, while cooling, hasn't disappeared entirely. What we're seeing is a repricing of risk premiums. The market got ahead of itself, valuations became stretched, and now we're going through a healthy, albeit painful, correction. The key question is whether this is a reset that creates buying opportunities or the beginning of a more prolonged downturn. I'm watching the Federal Reserve's next moves very carefully because if they signal they're holding rates steady through April, which some traders are betting on, that could provide a floor for risk assets. But right now, the path of least resistance is lower until we see some stabilization in the tech sector.
That makes sense. And speaking of tech, even companies with solid earnings like Alphabet are getting hit. They beat estimates, but shares are down in pre-market trading. It seems like good news just isn't good enough right now when the broader sector is under pressure. The risk-off mentality is really indiscriminate at this point.
Exactly, and that's what makes this environment so challenging for active traders. When correlations go to one and everything moves together, stock picking becomes less effective. You're essentially trading the macro narrative rather than individual company fundamentals. That Alphabet example is perfect. Strong earnings, but it doesn't matter because the sector is being repriced. We're also seeing some unusual moves in other markets. Silver plunged 17%, which is significant. And there are comparisons being made to the kind of liquidation events we saw in Bitcoin previously. The volatility is spreading beyond just tech and crypto into commodities and other risk assets. It's a reminder that when leverage unwinds, it can cascade across multiple asset classes simultaneously.
Well, speaking of individual stocks, let's shift our focus to our stock of the day, which is particularly relevant given this tech volatility. Lizzie, we're looking at Nvidia today, ticker NVDA, currently trading at 174.19. This stock is down about 7.75% year to date, despite being up almost 40% over the past year. Given everything we just discussed about the tech sell-off, walk us through what's happening with Nvidia and whether this pullback represents an opportunity or a warning sign.
Nvidia is really the poster child for both the AI revolution and the current market reassessment we're experiencing. Let me give you the full picture. This company dominates the AI chip market with over 80% market share, and they've been the primary beneficiary of the generative AI boom that started with ChatGPT and has spread across the enterprise world. Over the past year, the stock appreciated nearly 40%, hitting a 52-week high of 212.19 before pulling back to current levels. That's an 18% decline from the peak, and it's happening right as the broader tech sector is getting hammered. Now, here's what's important to understand about the current situation. Nvidia is trading at a price-to-earnings ratio of about 44 2/3, which on the surface looks expensive, but the forward PE is only 22.73. Which represents a 49% compression. What that tells us is the market is pricing in substantial earnings growth, and if that growth materialises, the current valuation is actually quite reasonable for a company with Nvidia's market position.
So the valuation story depends entirely on whether they can deliver that earnings growth. What are the catalysts that could drive that? And more importantly, what are the risks that could derail it? Because at a $4.24 trillion market cap, this is one of the most valuable companies in the world, and there's not much room for error.
You're absolutely right, and that's where things get interesting. On the opportunity side, we're still in the early innings of a multi-year AI infrastructure build-out. Data centers globally are being upgraded and expanded to handle AI workloads, and Nvidia's GPUs are the de facto standard for both training and inference. They've got the Blackwell architecture coming, which is their next-generation chip platform, and that could drive a significant upgrade cycle. Plus, they're not just a hardware company anymore. The CUDA ecosystem and their AI software platforms provide high-margin recurring revenue that doesn't get enough attention. And then there are emerging markets beyond data centers, like automotive and robotics, that offer diversification. Analysts have a consensus price target of $253.62, which represents 45.6% upside from current levels, and the recommendation is a strong buy based on 58 analysts covering the stock. But, and this is a big but, there are some serious risks we need to talk about.
Let's hear them, because I imagine regulatory issues are near the top of the list given the current geopolitical environment.
Regulatory and geopolitical risk is probably the number one concern right now. The H200 chip sales to China are still pending US State Department approval, and there are additional guardrails being considered to prevent technology breaches. China represents potentially 10 to 15% of the addressable market, so any restrictions there directly impact revenue potential. Then you've got competition intensifying. AMD is coming after them, Intel is trying to get back in the game, and perhaps most concerning, the hyperscalers like Google, Amazon, and Microsoft are developing their own custom silicon. Google's got TPUs, Amazon has Trainium, and while these aren't direct replacements for Nvidia's offerings yet, they represent a long-term threat to market share. There's also the question of demand sustainability. We're seeing tight supply conditions, which Wedbush analysis suggests means demand is still robust. But at some point, you have to ask whether AI infrastructure spending is approaching peak levels or if it's truly sustainable for multiple years. And finally, at these valuation levels, any growth disappointment would likely trigger multiple compression. The options market shows a 67% probability of the stock staying above 170 through March 2027, which means there's a 33% chance it goes lower.
So for investors looking at Nvidia today, what's the actionable takeaway? Is this a buy-the-dip opportunity, or should people wait for more clarity on some of these regulatory and competitive issues?
I think it depends entirely on your time horizon and risk tolerance. If you're a long-term investor with a 12 to 24-month view and you have conviction in the AI infrastructure thesis, current levels could represent an attractive entry point. That 45% upside to the analyst consensus target is compelling, and the forward PE of 22 for a company with Nvidia's competitive positioning isn't outrageous. However, you need to be prepared for 20 to 30% volatility, and you should size your position accordingly. This isn't a stock you want to overweight in your portfolio given the risks we discussed. For shorter-term traders, I'd want to see some stabilization in the broader tech sector before getting aggressive. The Nasdaq just had its worst two-day drop since April, and until that selling pressure abates, even high-quality names like Nvidia are going to struggle. The key things to monitor are the quarterly data center revenue growth rates, any news on China regulatory decisions, and competitive product launches. If data center revenue starts decelerating, or if they lose meaningful market share to custom silicon, that would be a red flag. But if they continue to execute and the regulatory situation in China gets resolved favourably, you could see that stock back above 200 by year end.
Now, let's talk about crypto trends, because this is an area that's been particularly volatile. Lizzie, Bitcoin dropped below 70,000 briefly. Ethereum is under pressure with Vitalik Buterin selling 6.6 million in ETF, and the overall market sentiment seems to have shifted dramatically. Give us your outlook for Bitcoin and Ethereum over the next week.
The crypto market is definitely in a bearish phase right now, and it's important to understand the drivers behind this move. Bitcoin's sentiment has turned decidedly negative. We saw it erase 15 months of bull market gains, dropping below 70,000 on some exchanges, and the fear gauge has increased significantly with 800 million in liquidations. Bitcoin ETFs are experiencing substantial outflows, 545 million in the most recent period, and total outflows have reached 2.9 billion as the price hit new lows for 2026. The Treasury Secretary's comment that the US won't bail out crypto added fuel to the fire, and there's this growing correlation between Bitcoin and the troubled software sector that's concerning. For the next week, I'd expect continued pressure on Bitcoin. Some analysts are even predicting a potential drop to 38,000, which seems extreme, but it shows you how sentiment has shifted. The key support level to watch is around 70,000, And if that breaks decisively, we could see accelerated selling. On the positive side, there are reports that Indian investors are buying the dip, and the price did briefly climb back above 71,000 when the tech sell-off paused, so there is some buying interest at these levels.
And what about Ethereum? The Vitalik Buterin sale seems to have spooked the market a bit, even though he flagged those withdrawals in advance.
Ethereum is facing its own set of challenges. The Vitalik sale of 6.6 million, even though it was pre-announced, created negative optics at a time when the market is already fragile. Ethereum's price is closely tied to the broader crypto sell-off, and sentiment has turned bearish. However, there are some positive developments happening beneath the surface. The Layer 2 ecosystem continues to grow, with new privacy-focused solutions launching, and there's ongoing innovation in the scaling space. Vitalik himself has been critical of what he calls Ethereum copy-pasta Layer 2 chains, saying the roll-up excuse is fading and these projects need to deliver more innovation. For next week, I'd expect Ethereum to remain under pressure in line with Bitcoin and the broader risk-off environment. The key factors to watch are the development and adoption of Layer 2 solutions, and whether the broader market sentiment stabilizes. If Bitcoin finds a floor, Ethereum should follow. But until then, the path of least resistance is lower.
It sounds like patience is the key word here, waiting for some stabilization before making aggressive moves. Well, that's all the time we have for today. Before we go, I want to remind all our listeners that the information we've discussed today is for educational purposes only. Remember, do your own research and consult with financial advisors before making investment decisions. Markets are volatile, and what we've discussed today could change rapidly. We'll be back tomorrow with more market analysis and insights.